Hello and welcome to ThePrint. This is Bidisha and you're watching Economics. India just hit record food production. Record wheat, record rice, record horticulture. We are celebrating bumper harvests across the country. Fields are full, procurement centers are busy, storage silos are overflowing. You'd think this means we are exporting more. You'd think our agricultural trade surplus is stronger than ever. But here's the counterintuitive truth. Even as our farms overflow, our ports are importing more food than ever before. How does a country produce more and still buy more? That's India's agricultural paradox. And today, we are breaking it down. Let's start with what the official data shows. Over the last 2 years, India's agricultural and allied imports have risen sharply, from about $53 billion to $63 billion. Exports, on the other hand, haven't kept up pace. They dipped, then recovered slightly, but overall have remained stagnant. This means our agricultural trade surplus, the buffer we've relied on for decades, is shrinking. From $19 billion to $16.3 billion to $15 billion. This is not an immediate crisis, but it is a clear direction and not a comforting one. So the big question is, why are we importing more, even when domestic production is strong? The answer lies not in the farms, but in the incentives that shape them. To understand why we import what we could produce, we need to look at the agricultural policy. For decades, India's approach has prioritized one goal above all: price stabilization. That means minimum support prices, subsidized fertilizers, government procurement guarantees. This gives farmers certainty. If they grow rice or wheat, the government will buy it at a fixed price. But this creates a trap. Farmers naturally choose the safest option, the crop with an assured buyer. So the system ends up encouraging the same pattern again and again: rice, wheat, sugarcane. Meanwhile, India's consumption has changed dramatically. Urban households want more fruits, more nuts, more vegetables, more processed foods, more proteins, chocolate, coffee, cocoa-based products. Demand diversified, but cropping patterns didn't. And when domestic supply can't match domestic demand, imports fill the gap. Not because Indian farmers can't grow these crops, but because policy incentives push them towards the old staples. It is not a failure of farming, it is a failure of design. There's another dynamic worth understanding. Whenever the price of a food item rises, onions, tomatoes, pulses, edible oils, what does the government really do? It opens the import tap. Tariffs are reduced, restrictions are lifted, shipments are fast-tracked. This protects consumers, which is essential, but then there's a long-term trade-off. When imports can always fill the gap instantly, companies don't invest in contract farming, retailers don't build long-term relationships with farmers, cold chain operators hesitate to scale up, food processors look outward instead of inward, and farmers see diversification as too risky. So the default response becomes, if there's a shortage, just import. That sounds efficient, but it slows down domestic capacity building. Take edible oils, for example. India has the land and climate for oil seeds, yet imports remain permanently high. Or look at cocoa. Demand is rising, domestic production hasn't kept up. Imports rise. Even dairy, a sector where India is a global leader, sees import spikes when supply tightens. And fertilizers, a critical input, still rely heavily on imported raw materials despite domestic capacity. The pattern is the same. Imports are easy, domestic investment is hard. Therefore, imports grow. Maybe you're thinking, if we need something, why not just import it? Here's the issue. India's agricultural trade surplus has historically acted as a macroeconomic stabilizer. Whenever services exports fluctuate, whenever manufacturing slows down, agriculture is the one that has provided steady foreign exchange. Countries like Brazil, Argentina, and Thailand use agricultural surpluses as strategic tools. India has that potential, but it is underutilized. When the surplus shrinks, foreign exchange outflow rises. India becomes more vulnerable to global price swings. The rupee faces more pressure and our import bill becomes harder to manage. The opportunity cost is huge. If India had aligned production with market demand and built competitive supply chains, our agricultural surplus could be 2 to 3 times larger. That could offset fuel imports. That could strengthen the currency. That could give us more fiscal room. Instead, we rely increasingly on imports for products that Indian farmers could grow profitably. The good news is that this trend isn't destiny. It's simply the result of policy choices and can be reversed through policy reform. A forward-looking strategy requires 5 things. Fix subsidy distortions, shift incentives towards diversification, not just more production of staples. Number 2, build quality infrastructure, grading labs, sorting facilities, certification mechanisms, essential for exports and domestic processing. Number 3, strengthen storage and cold chain networks, especially for fruits and vegetables where losses are high. Number 4, create predictable tariff regimes. Businesses can't invest in supply chains if import duties keep swinging wildly. And 5th, reform procurement incentives. Encourage states and farmers to shift towards oilseeds, pulses, horticulture, and high-value crops. The government has already begun focusing on oilseed missions and horticulture clusters. But these require sustained long-term commitment. Because the truth is simple. Indian farmers don't need more protection. They need more competitiveness. India stands at an important moment. We are producing more food than ever, but we are also importing more than ever. And our agricultural surplus, once a dependable buffer, is becoming thinner. This is not a story of failure. It's a story of misaligned incentives. The potential is huge. The capacity exists. The farmers are capable. What we need now are policies that reward diversification, quality, and competitiveness. Because India does not lack agricultural strength. It only lacks agricultural alignment.